Good day, students. This is Professor Buckholtz, and today we shall be discussing Chapter 7. Chapter 7 discusses the concept of audit evidence, a very important chapter, and really the core of what we're going to need to use in order to plan and actually conduct an audit. So again, several different objectives that we have over here. Let's just take a moment. We're going to contrast audit evidence with evidence used by other professions. Identify the 4 audit evidence decisions that are needed to create an audit program. Specify the characteristics that determine the persuasiveness of evidence. Identify and apply the 8 types of evidence used in auditing. Know the types of analytical procedures and their purposes. Compute common financial ratios. Understand the purposes of the audit documentation. Prepare organized audit documentation. The first objective. So this table over here contrasts audit evidence with legal and specific evidence. Basically, if we take a look at the use of evidence, first line here, in an audit, we're looking to determine whether financial statements are fairly presented. That's a little bit different, for example, than legal, which is where you're deciding guilt or innocence, or medicine, where you're determining the effects of using a different medicine. And we're obviously using our evidence to try to come up with a high level of assurance about whether the financials are presented fairly. So the auditor has to make 4 big decisions when we're talking about evidence, and not just evidence, ladies and gentlemen. How much to accumulate. And later on, we'll also see when to perform these types of evidences as well. So the 4 major decisions regarding how much, which audit procedures do we use. Everything that we audit is different. Auditing cash is different than auditing accounts receivable. Therefore, we're going to use different audit programs when we're doing different procedures. They're not going to all be the same. What sample size to select for a given procedure? As we said in the course, we are going to be sampling things. It's not all going to be the same. Therefore, do we choose 10, 100, 32? How do we decide? What items are we going to select from the population? We have a check register of 3 million transactions. What items are we going to select as our sample? And then, as I said before, here's the when to perform the procedures. An audit program includes all of the above information for a given audit. The third objective. The third audit objective talks about persuasiveness of evidence. Audit standards require that the auditor accumulate sufficient appropriate evidence to support the opinion being issued. Now, keep in mind, this is not telling us how much evidence to gather, just that you need to gather sufficient appropriate evidence in order to support the opinion being issued. Now, the 2 determinants of the persuasiveness of evidence are appropriateness and sufficiency. Appropriateness of evidence depends on, number 1, how relevant is the evidence, number 2, how reliable. Relevance of evidence means that the evidence has to pertain to what we're testing. We're going to test a cash account, a bank reconciliation. Well, we want to look at a bank rec. We want to look at a bank statement. If we looked at an inventory cutoff sheet, that wouldn't be relevant evidence when auditing the cash account. Reliability of evidence. Reliability of evidence refers to the degree to which evidence is believable or worthy of trust. Reliability of evidence depends on the following. How independent is the provider? The effectiveness of the client's internal controls. The auditor's direct knowledge of the subject. The qualifications of the individuals providing the information. The degree of objectivity. And lastly, timeliness. Sufficiency of evidence. That will refer to the quantity of evidence obtained. The sample size that is considered to be sufficient is impacted by two factors. Number one, what is the auditor's expectation of misstatements as a whole? Number two, how effective are the internal controls of the client? So the persuasiveness of the evidence can be evaluated only after we consider how appropriate is the evidence and how sufficient. And again, hopefully by the time you've considered the appropriateness and sufficiency, you believe that you've gathered sufficient appropriate evidence which is persuasive to form your conclusion. If after doing it you decide it is not going to be persuasive enough, then you have to go back and possibly gather more evidence in order to make your conclusions. In making decisions about audit evidence, persuasiveness and cost. Here's a new one. Cost must be considered. Now, please note, ladies and gentlemen, that were we back in our legal liability situation, we cannot walk into a court of law and simply tell them we did not do an audit procedure because we felt that it was too expensive to do. A court of law would not look on that favorably at all. They would not look on that favorably. So as a result of that, we need to make sure that the audit evidence, yes, we take cost into account, but really we need to look at the persuasiveness. And if we look at the relationship amongst audit evidence, decisions, and persuasiveness, this is really what we come up with. Audit procedures and timing. What are the qualities that affect persuasiveness of evidence? Is it appropriate, relevant, reliable? Reliable meaning how independent is it of the provider? If we see that the client has a trial balance with $1 million of cash, well, yes, it comes from our client, the provider, but is that the best independent evidence we can get? And hopefully many of you are saying, no, it isn't. We want to get something from the bank. That would show a little more independence. How effective is the internal controls? The auditor's direct knowledge of the subject. So if we know that a lot of people are short on cash, but your client has a lot of cash on hand, let's take a look to make sure that maybe something isn't maybe analytically out of whack that we need to look into a little more. The qualifications. Is the person giving you the evidence really qualified? How objective is the evidence? Timeliness. When procedures are performed and the portion of the period being audited. Sample size and items to select. Is it sufficient? Is there an adequate sample size? The selection of proper population items. The fourth objective. Let's take a look at 8 different types of audit evidence common in the audit profession and try to see if we can understand which ones are better than the others. So physical examination is the inspection or count of a tangible asset by the auditor. That's when we can actually look at an asset and see, touch it, examine it. Confirmation. A confirmation is when we request something from a third party to corroborate the information we're requesting. The typical one you'll see in your careers is the bank confirmation, where I'll send a confirmation to JP Morgan Chase, who will send the confirmation back to me directly as the auditor. Obviously, it will have the permission of the client, but then they will email it back to me as the independent auditor, hopefully confirming the amount that is on the client's books and records. Inspection. Inspection, a very powerful form of evidence. Looking at inspecting a document really provides me some good evidence. Now I can get 2 types of inspections, documents that are internal or external. When I use a document to support a recorded transactions, that's called vouching. So again, if I'm looking at the general ledger and I pick some items to view, I am vouching those items. Vouching. If I am testing a source document to recorded amounts, that's called tracing. So if I saw a stack of bills on the table for accounts payable and traced those to the general ledger, that's tracing. If I got the general ledger and traced it to, and went back to the invoices, that's vouching. And some information that's often confirmed, again, as we said, cash in bank, marketable securities, accounts receivable, inventory. Liabilities could be accounts payable. We can confirm with a creditor, although a lot of times your clients will not really want you to do that because you don't want the creditors to believe that a check is forthcoming in the mail. Analytical procedures. The evaluation of evidence of financial information through analysis of plausible relationships among financial and non-financial data and are required during the planning and completion phases of all audits. So again, when we're doing an audit, at the beginning of an audit and at the end, you need to use analytical procedures, which makes sense. At the beginning of an audit, I can see if any amounts are standing out or maybe are skewed. At the end of an audit, doing an analytical follow-up is perfect because now I can see after doing my audit, does everything still make logical sense? Is anything missing? Is anything out of whack? So the purpose of the analytical procedures are the following. Number 1, understanding the client's industry and business that's used in planning to gain knowledge about the client. Assess the entity's ability to continue as a going concern. Many ratios can be an indicator of potential financial problems. Indicate the presence or possible misstatements in the financial. When you do an analytical, ladies and gentlemen, you may actually find that something is wrong in the financial or doesn't look right, which could possibly trigger your client to book an adjusting journal entry. Possible evidence supporting an account balance. So if reliable relationships exist, substantive analytical procedures can be used to support an account balance. Meaning, if I am auditing a school and I have 100 students. Assume for the purposes of this example, it's $1 tuition, $1 tuition. I should therefore see $100, 100 students times $1 should be $100 of tuition revenue in the general ledger. Inquiry. Obtaining written or oral information from the client in response to auditor questions. Unfortunately, while being the easiest and the cheapest audit procedure, it is usually not considered conclusive. So if we go to Joe, and Joe indicates that the reason why the accounts went down is because it was a decrease in the use of supplies for the year. So why did supplies go down? Because we used less. We need to get more evidence. Maybe looking at some of the bills, vouching or tracing to see why the bills went down. Accepting just a response from Joe alone would not be enough. Recalculation, rechecking a sample of calculations made by your client. Reperformance, the auditor's test of client accounting procedures or of controls. So again, recalculation, we're going to recheck a sample that was made by the client. Reperforming, observation, watching a process or procedure being performed by others. Now, again, a practical problem with observation is if somebody knows they are being watched by another, chances are they're going to do this properly because they know they are being watched. The appropriateness of evidence. So we're going to look at table 7.4 shortly, but obviously looking at these criteria, the effectiveness of a client's internal controls has significant influence on the reliability of most types of audit evidence, especially internal documentation and analytical procedures. Physical examination and recalculation involve the auditor's direct knowledge and are likely to be highly reliable. Typically, inquiry alone is usually not sufficient to provide appropriate evidence to satisfy any audit objective. And again, if we look at table 7.4, a good table that kind of shows you how reliable the evidence is. So looking for the sake of argument, here's that inquiries again. What's the independence? Very low because the client provides it. The internal controls has nothing to do with it. Our knowledge of being an auditor with this is low. Qualifications vary, as does the objectivity. So again, that's why inquiries would not be very good. Whereas reperformance kind of gets high across the board because the auditor does it. So again, how appropriate is the evidence? There's a lot of different mitigating factors and circumstances which would impact that. Looking at some of the cost of the types of evidence. So the most expensive types of audit evidence is physical examination, and confirmation. Moderately costly, and again, we're talking costs that we as the audit team are incurring against our engagement fee, and sometimes we may or may not be able to recover all that when we do our pricing. We've got inspection, we've got analytical procedures and reperformance. The least expensive is observation, inquiries of the client, and recalculation. Objective 5, knowing the types of analytical procedures and their purposes. So the purpose of an analytical procedure, so during the audit engagement, analytical procedures are required in the planning phase as part of risk assessment to understand the client's business and industry. Analytical procedures are oftentimes done during the testing. You are allowed to do them during the testing. It is not required. but you are allowed to do them. Analytical procedures are required during the completion phase of the audit. So again, our auditing standards very explicit. Analytical must be done in the beginning of an audit as well as the end of an audit. The types of analytical procedures. When we're doing an analytical, the auditor will compare data with industry data, what's going on in the industry. So if we have a co-op or a condo and we do a group of them, and one co-op and condo their heating bills went up because it was a colder winter. We go down the block to another co-op, the heating bills have gone down. Analytically, that doesn't make sense. How can one building be heating, another one not heating? Similar prior period data. Client determined expected results. Typically, we will ask a question to our client saying, how did you do against your internal budget? And if the client says they budgeted $1 million surplus and came up with an actual of $900,000, that's not bad. If the client, however, budgeted $1 million surplus and came up with a $3 million loss, there's a problem. Another type of analytical is the auditor determined. That was the example I gave you before with the tuition. 100 students times $1, $100. Internal comparisons and relationships are further explained in Table 7.6. So again, raw material turnover for a manufacturing company. It's ratios. What's the possible misstatement? The statement of inventory or the cost of goods sold or obsolescence of raw material. Sales commissions divided by net sales. What's a possible misstatement? The statement of sales commission. Another one, bad debt expense divided by net sales, misstatement in the allowance. So by looking at these certain types of ratios, we can see as auditors if something looks askew. An example over here of a test of interest expense. So basically what the auditors did here is came up with an average interest monthly balance and then an average interest rate. And what they basically did is coming up with the average, their expectation was 2.399315. The interest in the general ledger was $2,000,004. Therefore, we have a $9,000 difference against our expectation, which again, taking a look at this work paper, looks like it's not that material. So this is a better way of doing it as opposed to going through each and every single monthly statement to try to see what the actual invoices said in terms of the interest expense. That would be still a good procedure, but it may not be as efficient a procedure. Whereas this here gives us something reasonably comfortable and close. The sixth objective, computing common financial ratios. So again, we have several different types of ratios, and you've seen many of these before in your accounting career. The first, short-term debt paying ability, the cash ratio, the quick ratio, and the current ratio, which again will tell us in the short term, can they pay debt as a company? Liquidity. How quickly are we able to generate or turn something into cash? Accounts receivable turnover. Days to collect receivables. Inventory turnover. Days to sell inventory. Ability to meet long-term debt obligations. So there's debt to equity times interest earned. Profitability ratios. Earnings per share, gross profit percentage, profit margin, return on assets, and return on common equity. These are several that show how profitable is your company. Objective 8, preparing organized audit documentation. Audit documentation is the record of the audit procedures that we have performed and the conclusions we have reached. Very similar to what you saw a few slides ago. The purposes of the audit documentation, very important, and most audit documentation today is electronic. You're not going to manually do it. It serves as the basis for planning the audit. It's a record of the evidence accumulated and the results of the tests. It's data for determining the proper type of audit report. The basis for review by supervisors and partners. Who owns the audit files? All audit files are the property of the auditor. They are the property of the auditor when it's an audit file. Now, the client records themselves are the client's, and it is not ethical or proper to keep client invoices. You should return those immediately. You're not allowed to hold them hostage, so to speak, if the client doesn't pay your audit fee. That would be an act discreditable to the profession. Please keep that in the back of your mind. Confidentiality of the audit files. The Code of Professional Conduct states that you are in public practice and you shall not disclose any confidential client information without specific consent. There is an exception to this, which the clients know. If we are subpoenaed or peer reviewed, we've spoken about peer review before, then we are allowed to turn over the files. We do not have client attorney privilege, so to speak. We don't have that. There is no client auditor privilege. If we get a court order, we give them whatever they ask for. What are the requirements for retention of audit documentation? Auditing standards require, if you audit private companies, 5 years. Sarbanes-Oxley says that after 7 years, you need to keep the work papers if you're auditing public companies. Now, because we are in New York State also has a rule that after 45 days, you are supposed to lock down your work papers. What that means is that after 45 days, you should be making no modifications, edits, deletions, additions, review of work papers to the file. It should all be done theoretically before you even release the audit. So why do you say, is there a 45-day rule? Well, you may need to clean up a couple of things here and there. You may need to get a review note cleared from a staff person and then signed off by a manager. Little things. But if you release the report and then on the 45 days start auditing accounts receivable, well, that's going to be a very big problem. So how does your audit files typically get arranged? And you'll see, I'll show you briefly here, the audit file typically will contain the financial statements and the auditor's report, the trial balance and any journal entries that have been proposed either by the client or you, the audit program, your planning and risk assessment, your understanding of the internal controls, test of controls and substantive test of transactions, test of details of assets and of liabilities and equity, contingent liabilities and audit completion. That's your current audit file. There's another file which can be electronic, which is permanent files. They contain data of historical or containing nature. This usually is stuff that doesn't change from year to year. It's always the same, and typically will be documents such as bylaws, articles of incorporation, bond agreements, lease agreements, long-term contracts, analysis of accounts that from previous years still have continuing importance, information related to understanding internal controls and assessing the control risk, and the results of the analytical procedures from prior years. That would be permanent files. And again, as we said, this would be your current file. An example of a working paper current file would be our financials showing the cash. The cash would then go to a working trial balance, which shows what the final balance is. It then goes to a lead schedule. And the lead schedule would show you all the cash that they have and what's actually being audited. And again, most of this would be done electronically. It would not be a manual file. Preparation of the audit documentation should be done so that somebody who is unassociated with the audit can come on in and know what you did as the auditor. That's a very important step. So your audit work papers should be identified with the client's name, what you're auditing, a description, meaning procedures, scope, source, objective, who prepared it, which auditor, when was it dated. All the files in your audit binder should be indexed and cross-referenced. It should indicate the work that was performed and what you did. Again, if somebody can question what you did, it's not a good work paper. It should also include any conclusions that you came to about the audit objective that you were doing, and include sufficient information to fulfill the audit objectives. Keep this in the back of your mind. If you go to court, the first thing the lawyers will look at are the work papers. If those work papers are not up to snuff, you can end up losing the court case. And that concludes our discussion on this chapter, Chapter 7. Again, we suggest you go back, re-listen to this video, and then complete any and all assignments that you may have with this chapter. Thank you, and we'll see you online.